Welcome back to another episode of the Isn't That Rich podcast. Today we have on one of our favorite financial advisors from Forbes Financial, Mr. John Forbes, and we are going to be talking about how the election influences the stock market and what you need to do as an investor. So, John, welcome on again.
Welcome, Thank you. You guys, I've always loved spending time with you.
Yeah, we're glad to have you back.
Yeah,
it's been a while, though.
It's been, as the kids say, it's been a hot minute.
Yeah.
Yeah.
Is this a busy season for you with the election coming up?
You know, anytime there's uncertainty, the phone gets picked up a few more times than normal. But it's
business as usual.
Business as usual.
Okay.
Yeah.
Why do you think that is?
Well, next month will be 29 years I've been in the business, and most of my clients know what I'm going to say before they even call. They just need to hear it. So I've got a lot of clients that just have given up on calling me because they know what I'm going to say, and we're going to stay the course, and we've got a plan and all the things we say. So they don't tend to get too wound up. But the election cycle absolutely brings the worst out of every investor as far as potential mistakes and pitfalls to avoid.
Yeah, I'm excited to talk about it today so I can learn a few things.
Yeah.
John, so the election's less than a month away.
Yeah.
And some people think that the stock market can predict election outcomes.
Yeah.
Yeah. Can you walk us through that and show us historically how that could be?
Absolutely. Yeah. If we look at the last 24 election cycles, the stock market has accurately predicted the winner 20 out of 24 times. And here's what I mean by that. If you look, and if you think about it, it kind of makes sense. You know, you heard the old adage, people vote based on their pocketbook or their wallet, or in these days, their IRA balance or their 401k. When the market is doing well in the 3 months prior to the election, the incumbent party in the White House generally wins. So from August 6th to November 5th, if the stock market is up, historically, whoever's in the White House, that party stays in the White House.
Really?
If the market is down in that 3-month period, the incumbent party usually gets voted out, because if people are confident about their money, so it's interesting, but there's always exceptions. Mm. And the 2020 election, the market was up for the 3 months prior to the election, but President Trump still lost. So it's not a perfect model, but it's amazing how consistently accurate it is on whether or not an incumbent will win. Now, there's lots of things going on sideways. We've never had a candidate remove himself and get replaced. There's all kinds of things going on that make it a little bit different. And the fact that 2020 broke the mold, prior to that, 20 out of 23 elections, that model of looking at what's going on in the stock market would be a really good indicator of what was going to happen at the ballot box in November. So it's worth taking note and being aware of, for sure.
So is the stock market up or down right now? Has
stock
been up
market's
or down?
Up quite a bit since August.
Really?
Yeah, stock market is up. That would be a positive indicator for Kamala Harris winning. Again, anything can happen between now and then, and there's other factors that can influence an election. But I think it also leads to another kind of conversation we can have in that after doing this for a few years in Carbondale, I've got plenty of conservative leaning clients, and I've got plenty of progressive clients. And something I've been saying for years, and this is a great time of year to be reminded: money's not red, money's not blue, money's green. So we can't get too hung up on who's in the White House. And a little later, I'll get into some nuggets that really bring home why we can't look at our finances through a political lens.
Mm. That leads me to a great question. So when it comes to the election season and the volatility in it, do you recommend getting out of the stock market or staying the course?
Oh, wow.
I know the answer,
I think you know the answer. Yeah. I tell you what, timing the market is very difficult. Now, the only way I would change this answer is if I could get Marty McFly's DeLorean and go back in time and based on what I know now, make changes. But whenever we point out whatever the chaos of the day is, maybe it's an election, maybe it's geopolitical concerns, maybe it's weather and climate related issues, any of these things, that I like to say it's all baked into the pie already. We can say, well, we got an election coming up, I'm going to get out, and this isn't a good time to be. Well, no, the market has already priced in that uncertainty, the uncertainty of what's going on in the Middle East. When that calms down, I'll get back in. Well, when that calms down, the market's up 20 or 30%, and you missed, because rarely will the sky be completely blue. So what we do is make sure that we have strategies in place to accommodate the what ifs, to accommodate what happens. What if the market sells off and it takes 2 or 3 years for it to get back? What do I do if I'm retired? What do I do? Where do I go to get money? I don't want to be selling. So, well, we have strategies in place where we've got other investments available that historically, when the stock market goes down, they go up. So as long as we're always dipping from the right pool, we can weather those storms. And there's strategies that we come up with and put into place for retirees. When we talk about younger investors, my gosh, when you're 30, 40 years away from retirement, this volatility is just a blessing. It's fantastic, because if you're participating in a retirement plan at work, and you're consistently putting in the same dollars, out of your paycheck every pay period, the volatility completely works in your favor. Because, and I'm going to over exaggerate just to make the point, let's say you're putting in $100 a paycheck, and you're buying a fund that's extremely volatile, and it's $10 a share right now. Well, that $100 buys you 10 shares that week. Now, if it jumps to 20 the next pay period, your same 100 is only going to buy 5 shares when it's 20. If it drops to 5 the next pay period, you're buying 20 shares when they're on sale. So by consistently just dripping into the market, volatility is your friend. You by definition, you accumulate more shares cheap and fewer shares when they're expensive. And it's there are so many things. If I could go back in my DeLorean, even to tell myself, 30, 40 years ago what to do, just staying consistent and not being persuaded by the noise of the day, and just stay diligent and consistent. And it makes all the difference in the world. I can work with anybody making any amount of money and make them a millionaire in 30 years if you're just diligent and patient with the market.
I love what, I'm sorry, John.
Well, I was just going to say, it's good to hear, because I feel like there's a lot of volatility right now. We just had this huge hurricane. There's stuff going on in the middle, the war, all of this stuff is going on. And I feel like that, for me as an investor, brings a lot of emotion into some of my decisions. So that's good to hear that during those times of volatility, that there can be.
I love the advice that you give about going on a media fast, because a lot of the times, like those things, like Jill's saying, your emotions play into your investments. And so if you just turn off the TV, which maybe it's not a good idea to turn off the TV sometimes, we do need to know what's going on. But instead of just like relishing in all of that, just take a step back. Yeah, no, it's something where I was going to say not to pick on media, but I'm going to pick on media a little bit. Their job, especially, I get a little frustrated with financial news networks. Their job isn't to make you a better investor. Their job is to sell advertising. Their job is to get clicks and get eyeballs. And
kind of like our job.
Yeah.
No, but no, I didn't mean that.
I'm teasing you, John.
No, but when we look at if the market opened and they announced, that the stock market's going to fluctuate today, it's going to go up, it's going to go down, it's generally going to follow the price. The price is going to follow what's happening with profits and dividends of companies. You could shut down for 23 and a half hours and then turn it back on and do 30 minutes again. It's really that simple, which is really hard to do, but it's really that simple. And if they were wanting to make better investors out of people, that's what they would focus on, instead of trying to create, the red bar at the bottom and the ding and the panic, and we got to wait and see what the Fed's going to say next Wednesday at 11:15.
Oh yeah,
stay tuned, and they create this hyper false sense of, okay, if I know something, I'll be a better investor. If you don't know it in the right context, it's going to make you a worse investor, really.
Do you feel like conversations, and maybe I just don't know this because I haven't been in banking so long and I'm younger, do you feel like conversations about the Fed have, I guess, increased or been more pertinent than ever before because of like COVID and the big dip and then it coming back up? Like, yeah. I feel like the Fed, people know more about the Fed than they ever have before, or they base things off of the Fed. I could be wrong. Yeah. I'm just asking your opinion.
No, I think that's actually a really good observation. The Fed has gotten a lot of attention.
Yes.
And in part, it's because we've had some atypical things going on for a number of years. When we talk about the Fed and their role, when they change rates, that's one arrow in the quiver that they have, but there's many others, but let's just focus on that one. If we think of the Fed as a doctor, think of them as think of the Fed as almost like an ICU doctor. When they are cutting rates, it's because the patient, the U.S. economy is struggling and needs assistance. So they cut rates and cut rates and cut rates, and they keep doing that to try to provide oxygen for the economy to recover. So when you cut rates and get them down to zero, which is practically where they were for an extended period of time, if you think of it in terms of medical, that's a patient that's dying that they've done everything they can do to try to save it. They've desperately, now there are many other tools that they have access to, but when the Fed leaves it that low for that long, and then we follow it with COVID and the global government response is we're going to pay people to stay home because we don't want the economy to fall apart. Well, if there's no production happening, yet everyone has consumers have the same money, you've got more dollars chasing fewer things, which creates inflation. Well, the trade-off was they'd rather have inflation than a global depression. So we can argue about whether that was good policy or not, but that was the direction they went. The medicine you have to take afterwards is, okay, we've spiked all these prices. Now we got to cool things back down again. So the way you cool an economy is by raising rates. And so with the Fed raising rates for a couple of years, it was really hard on the bond market. But the economy was pretty resilient through that. And now we're starting to hit some softness where there's pockets of really good numbers and pockets of things where it's just hard. When prices go up 20, 30, 40% for groceries and fuel and things like that, it has an impact. So now the Fed's realizing, okay, the patient's starting to struggle a little bit. We need to start cutting rates. So if we think of it in those terms, a healthy patient, you don't have to raise rates or lower rates. They just kind of stay where they're at. But in the meantime, the Fed's very focused on trying to help the economy grow while keeping inflation in check. And it got out of whack. And to their credit, they used a lot of tools and a lot of arrows in the quiver, and they've got inflation back down to that 3%-ish number. So now they're going to turn their attention from inflation and start focusing on how do we help the patient get through this gently. So this is where you start hearing about things like the soft landing, or are we going to have a recession? And that's the stuff they're trying to navigate now more so than inflation.
Because that's what I was going to ask you next is like, it doesn't, so we said, or you mentioned that the market is up right now. To me as a consumer, it doesn't feel like it. I feel like the price of everything is up, and so that inflation is hurting me as a consumer. And I would love to ask you, looking at history, is there a particular balance of power in Washington that the market tends to favor?
Yeah, that's a fantastic question. And yes, there is. And this is where I love, again, going back to my clients, I've got lots of conservative clients and lots of progressive clients. And when you look at everything through a political lens, you think, well, if my party's in power, we'll be fine. And when you go back and look over the last, since 1958, the stock market does best. You have the best performance when you have a Democrat in the White House and Republicans running the Senate and the House. I don't want to quote the number, but it's the highest combination you can get in performance. And when you think about it, I guess it makes sense because Wall Street's looking at Washington all the time. Washington has this really uncanny knack of not making good decisions for the corporate world. So when you've got divided government like that, Wall Street and Main Street looks at that and says, hallelujah, that's great. They call it gridlock.
Gridlock. I knew you were going to have gridlock.
Yeah,
I've learned that from John.
Yeah, they call it gridlock in Washington. Everybody else is like, oh, thank you. Okay, they cannot mess anything up because when you get both parties in pretty significant roles of power, no one wants to let go of power, so they don't acknowledge that the other side might have a good idea. So the market loves that. That's a stalemate, and we win. The worst combination the stock market can have is a Republican White House with a Republican House and a Republican Senate. Historically, those are the lowest performing years in the stock market. And I share that because I can't reiterate enough, when we look at our finances through a political lens, we will make mistakes. And if we understand, sadly, Washington has become entertainment.
Yeah.
And when they've got two characters that can kind of go back and forth, and that's not a new thing. If we go back and look, President Reagan had Tip O'Neill, Bill Clinton had Newt Gingrich. We have these Mitch McConnell, Barack Obama. There have been, when you have two sides that both have some power, that's when markets have historically done really well. And again, full transparency, my third daughter's name's Reagan. So I tend to fall toward the right politically. But I say that because I tell all my right-leaning friends, your portfolio did fantastic under Barack Hussein Obama. Mm-hmm. And when you go back and look at the numbers, it's like, oh, wow, yeah, that was a good period. So looking through the political lens is just so destructive to portfolios on both sides. You can't, and in fact, this is here's a nerdy wonky thing for you. Well, I went back and looked, and if you had taken $10,000 in 1950 and decided, I am only going to invest when there's a Republican in the White House. If the Republican's not in the White House, I'm getting my money out. That 10,000 from 1950 to 2024 would have grown to just over $1 million. Not bad. If you were left leaning and said, I'm only going to have my money in the market when a Democrat's in the White House, mm-hmm. your money would have grown to $3 million.
Oh my.
Wow.
If you'd have left it alone the whole time, it would have grown to $32.5 million.
Wow.
So looking through a political lens consistently leads investors to make really, really poor, irrational, illogical decisions. Mm. But unfortunately, the market's not about rationality and logic. It's about emotions. And that's what I tell people as a financial advisor. About 25% of my job, in again, full transparency, about 25% of my job is investment selection, asset allocation, all the normal stuff you would think of. About 75% of my job isn't investment management, it's investor management. Mm. When someone calls in a panic, do we need to do something? No, we don't. We knew this was coming. We knew something like this was going to come. We're okay. We've got a plan, and keeping people from panicking and hitting that that panic button. I can't take it anymore, because that takes a temporary loss and locks it in permanently. Because that getting out and then waiting for things to look better, what you're saying is, I'm going to get out low. I'm going to wait and buy high. Now, when you say it to yourself, it sounds rational until you really look at what that leads to. So yeah, it's something where keeping investors from harming themselves is a big part of what a good financial advisor does.
Another thing as a financial advisor that you walk people through and help people with is taxes and talking about economic policy. So what is that kind of looking like with the election coming up, and what should investors know about that?
This is the thing that I don't know that investors are aware of. Back in 2017, after Trump had won, there was a new tax overhaul that was done. The Tax and Jobs Act of 2017 or something, I think is what it was called. When it passed, it was passed with a sunset provision that everything we just did goes away December of 2025. And it's so you give people a chance to tweak a policy down the road. Well, this election, whoever wins president is going to have probably a lot of say in what that next tax act looks like. If they don't replace anything, if they just let it expire, which is crazy, and I don't think they will, both parties have an incentive not to let that happen. Personal tax rates all go up. The corporate tax rate goes from 21% to 35% again.
What?
Yeah. So these are the things that will happen automatically if nothing is done different. And just like anything else in Washington, my gut says whoever wins, and I just went to a economic and policy meeting with some economists that I follow, and they're saying, as it stands right now, the House is a toss-up. The Senate looks like it's probably going to go Republican, and they peg Trump at about a 60% chance, President Trump, of a 60% chance of winning. So there's a pretty good chance for divided government at that point. If that's the case, then after the 2024 elections and everyone gets their seats in January, they are going to huff and puff and howl and scream and yell about the tax act expiring in 2025. And rather than coming out in the first quarter or even the second quarter and saying we've got a sound thing, it's going to wait until the 11th hour, because politicians for some reason are obsessed with negotiating and knowing that if there's a deadline, you're more likely to get the other side to cave a little bit. But you've got two very adamant powers dueling over this, and I don't think that's going to be good for the economy. So yeah, that's the biggest thing that's on the table that most people don't know. The estate tax provisions.
The big one, right?
The big one, yeah. The estate tax exemption drops dramatically if they don't do something.
Isn't it like to 2 million or something?
I think it goes from 11. Right? I want to say it goes from 11 to 4.
Okay.
I don't care, but it's dramatically different. So these are the kinds of things that there's child tax credits. There's all kinds of things that there will need to be new policy. I don't think they want to go back to what it was before.
Some people, John, think that we're headed towards a recession, but I want to get clearer on what a recession actually is and what defines it, and if we're likely to face one soon, in your opinion.
Yeah. Well, a recession in its simplest definition, this isn't in total, but it's pretty close. A recession is when the U.S. economy, instead of growing, shrinks a little bit, and it does it 2 quarters in a row. 1 quarter of slowing down isn't considered a recession, but when you hit 2 quarters consecutively, that's when the yellow flags and the red flags start to come out. And when we think of a recession, we've had very, very challenging, deep recessions in the past. And we've had very, very shallow ones. You know, if you think if GDP were, it's still currently positive, but if it were to go negative by 0.5% and then negative by 0.5%, that's a pretty shallow recession. It's easier to kind of come back out of that. When you see the economy slow down 2%, 3%, and do that back-to-back quarters, okay, then you're headed for some pretty significant changes. As far as, do I think one's coming, the folks that I follow are leaning toward, to the Fed's credit, it seems like the soft landing is what they've been aiming for, is where we slow down. Maybe we just kind of get down to break even and then come back up, or if it is a recession, it's very slight. That's kind of the camp that I'm in right now. I don't think there's anything that we can see right now that would make the compelling, obvious case that this is going to be an awful recession. It's just not, it's not there. Now, if, then you get into all this discussion starting to remind me that we misnamed my kids. Their middle name should have been Yeah But, and I know But. And
consult your tax advisor.
consult your tax advisor.
I forgot about that.
All those things. But yeah, anything could. If we have something crazy happen in the Middle East, you don't get run over by the train you see coming 2.5 miles down the track. So we know there's an election. We know there's geopolitical concerns. We know that there's been a hurricane and another one coming. All those things we know. That's not what would derail an economy. What derails an economy is a 9/11. Mm. When something dramatic that nobody really saw coming suddenly creates a shift that we have to take into account. That's when you get dramatic drops in a market. I don't see anything. Anything could happen, but right now I don't see anything that makes me think we're going to have a really ugly recession. I just don't see it.
When's the last time we had a recession?
Technically, we had a recession, and this is where there's a lot of debate, but during COVID, when we shut everything down and the economy just came to a standstill for a little while, it was a significant recession, and it was the shortest on record. Mm. So when I look at recessions, you think back 2007, 8, 9 with the banking crisis. Mm-hmm. We had a slowdown in the economy then. Back in the 90s, we had a couple of recessions. We've again, kind of to the Fed's credit, we've done a pretty good job of skating around a lot of that. But what it's led to, in the past, we would have lots of growth and then lots of drop and lots of growth. Well, now we're just kind of having a little bit of growth consistently, and then there's good to be had from that.
What is the difference? Well, I know there's a big difference, but maybe you can talk about this. What's the difference between a recession and a depression? And do you ever see a depression happening? I know you don't have a crystal ball, but...
Oh, wow. That's a great question. Well,
I just feel like it feels like mayhem right now. When I know I'm talking about the news, like you watch it, and we've just talked about all the millions of things happening. It feels like God's close to coming back. Yeah. So I'm like, these are, I feel like this is where it pulls in your emotional side. Like, we live in America, and it's wonderful here. And like, we were all at lunch the other day watching, Israel, and we're just so desensitized. And it's like, looking in America, is there that possibility that, I know there's always possibility, but...
Yeah.
That's a loaded question, John. I'm sorry.
No, it kind of is. And I would say, if we look back during COVID and the steps that the governments globally took to spend money that they didn't have, but to get money into people's hands. So, you didn't have a quarter of the workforce lose their jobs, or a third of the workforce lose their jobs, or more. That the argument could be made that without doing anything, we could have had a global depression. It had that happened. So, yeah, it's been quite some time since we've had the depression. 29, 30, 31. Throughout that, I don't see anything. I think governments have shown that they're willing to spend tomorrow's money today to avoid an immediate, significant, destructive hit to an economy. Now, you can't keep borrowing tomorrow's money for today. There's a cost to that too. So they have to be measured in their responses. But no, I don't. The difference between a recession and a depression, it reminds me, there's a joke Ronald Reagan used to say. A recession is when your neighbor loses his job, and a depression is when you lose yours. The depression is a recession on steroids.
Yeah. So I want to talk, I know we mentioned the bond market just a little bit earlier, and what happens when Fed cuts rates, but how do those bond markets typically respond to that?
Yeah. It's kind of funny. Typically what we see is if interest rates start going down, bond values tend to go up, because if I had a bond that was paying 5% and the going rate now for a bond is 4%, mine's more valuable. So when rates go down, it makes bond values go up. All that being said, that we just had a rate cut of 50 basis points, and interest rates are higher now than they were before the rate cut. So what that tells me is that the bond market kind of sees the writing on the wall. They know this Fed is going to cut interest rates, and it's just a function of, will they cut them at the pace that the bond market thinks they're going to cut them, and that will come into play. But the bond market is already pricing in what we all know, that the Fed has said we're going to cut interest rates to get the economy moving again. What you see when rates get cut, most notably, is you start to see rates on CDs, for instance, start going down. We had a period there not too long ago where you could get 4 or 5% on fairly short-term CDs.
It's kind of a frenzy at the banking.
Kind of a frenzy.
We were very popular.
Yes, and the likelihood of that 1 year CD that was earning, say, 5% 3 months ago, getting renewed at 5% is pretty slim.
Yeah.
And that's what Fed cuts will do to interest rates.
Okay. Well, as we come to a close, I've got a couple more questions. What are some big mistakes investors tend to make right now?
Wow. They're almost timeless, but it does seem like the election brings them up with more clarity. Looking, I sound like a broken record again, looking at finances through a political lens is a significant issue, a significant problem that people have.
Bad mistake.
And then when I'm having a conversation with someone and I explain something, I say, as soon as I say this, it's like, oh, poor thing. When they say, but this time it's different. No, it's not. But this time it's, but I know, but when people lead with that, no, that doesn't generally hold water. So when people either look through a political lens or they convince themselves, well, John, I know the facts and the history and everything you're telling me, but this time it's different. No, it's not. It really isn't. Then I guess the other ones that jump out at me are, there's a tendency for investors to look in the rearview mirror and see what's done best lately and say, I want more of that. And that you see that not only in times of volatility, but even in times of calm. There's a tendency to say, well, that one fund that's up 28%, the other one's only up 3%. I want the 28%. When the way markets cycle, they take turns leading, and that's not probably the best time to make a change. And then the biggest one, I think, and it's one thing that I don't think people necessarily acknowledge, but probably should. Fear is not a strategy. Being afraid of something that's going to happen is not a strategy. Being afraid of something happening is an awareness of what's going on, but it's not a strategy. Yeah. So if you're afraid of something that's going to happen, then the next thing should be, okay, so what are we going to do about it? And I'm afraid that the market's going to go to heck in a handbasket if X wins the White House. Well, okay, facts don't really support that, but what are you thinking we should do? Well, we should get out of the market. No, that doesn't tend to work. Let's come up with another strategy. And again, it's a function of, when you're investing money, why are you investing? What is this here for? Is it here to provide an income for you, over the next year or two. Well, if it is, CDs are a great place to park some money that you're going to need short term. There's bond strategies that we can use for short term money. We shouldn't have the money that you're needing to draw, and we know you're needing to draw it, whether it's for a down payment on a house or it's supplementing income or whatever it is. We shouldn't have that money in an aggressive growth fund or even in the stock market at all. There's other tools that are far more appropriate for that money. So when you have that strategy in place and you know why you're invested in what you're invested in, the role it's playing, then you don't let the noise of the moment distract you from success.
So I know we talked about obviously mistakes that investors are going to be making, but what are some things that they should be doing right now?
Yeah, breathe in, breathe out. Don't get.
You really are like an emotional management.
It really is. It really it's yeah, it's true. We cannot let emotions dictate. A short-term headline or an emotional fear or even greed. It goes both ways. We cannot let those emotions dictate or influence our long-term perspective and our long-term outcome. And it's easy to say it, and clients will have that conversation and they'll agree. And then 2 weeks later, something's going to happen and they're going to call me, oh my gosh, XYZ happened. What should we do? We just talked about this 2 weeks ago. We've got to, it's okay. I'm for any football fans, Aaron Rodgers came out a few years ago and at a press conference, and he said, RELAX, relax. It's going to be fine. And I think he was right on a number of fronts.
Yeah. That's a good tip.
Lots of good tips, John.
If you could leave our listeners with one piece of advice before this election, what would you tell them?
Be kind to each other at Thanksgiving.
That's a good advice.
Don't let whatever happens the first week in November become more important than the people sitting around the table.
That's good.
I thought you were going to say something else, but that's really good.
You thought I was going to say something appropriate?
I thought you were going to say again, don't view things through a political lens, but you've said that 5 months ago.
It's
I think that's the point of this episode is to just not view things through a political lens.
Yes, agreed.
Well, John, thank you so much for being on our podcast again. I feel like I've learned a lot about how to react to the election with my money. So I feel good walking away from this conversation. What about you, Jill?
Yeah, I loved it. I really loved your analogy with the doctor.
Yeah.
That hit home for me. So,
well, thank you, guys.
Yeah.
It's always good spending time with you guys. Enjoy it.
Thanks so much, John.
Thank you again. And we will see you all next week. So, Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. And we'll see you next week.
See you next week.